Hello and welcome to Dialogue. The U.S. Federal Reserve has cut its benchmark interest rate by 25 basis points from 4.25% to 4%. It's the first rate cut since December 2024. The move follows months of easing inflation, but also comes amid a cooling labor market and mounting political pressure from President Trump. Was the decision driven more by economic data or political calculation? What does it mean for business, consumers, and the global economy? And how will China and other countries respond? Join us for discussion today, live from Beijing. I'm Xu Qinduo. Joining me today, Professor John Gong from the University of International Business and Economics, Daniil Manaenkov, U.S. forecast lead at the research seminar in Quantitative Economics at the University of Michigan, Kathleen Tyson, founder and chief executive of Pacemaker Global, and Anthony Chan, former JPMorgan Chase Chief Economist. Welcome to Dialogue. So, Kathleen, I will start with you. Obviously, the rate cut is not a surprise, as many people expect the move to be taken by the Fed. But the Fed's, their concern seems to be mostly about the softening labor market rather than inflationary pressure. So, tell us more about this labor market. How big a challenge is there, or a risk is there?
Well, this concern is something. But I think my concern has been the unreliability of the reported numbers, that there have been massive revisions to the reported job numbers from 2024, which indicate some challenges in data collection and data interpretation. So for a data-driven policy, which is what Jerome Powell always says he's delivering, indications that the data is becoming unreliable are, of course, going to factor into whether monetary policy is appropriate to the conditions.
Mm-hmm. Well, Andy, Fed Chair Jerome Powell said on the job market that lower immigration, not tariffs, are having a big impact. Quote, there's very little growth, if any, in the supply of workers. If that's the problem, lack of supply or immigration here, so can lower interests help in that regard?
That's for me?
Yes, Anthony, please.
Okay, well, it is true that the labor market is facing some supply challenges. We know that because of deportations and less immigration into the United States, we are seeing that the labor supply has come down. But at the same time, the softer economic growth, keep in mind that last year, the economy grew at 2.8%, and this year will probably grow somewhere around 1.5, maybe 1.6%. So it's slower economic growth. So guess what? Labor demand has also come down. So that is the reason why the unemployment rate has come down, but it's come down, it has not risen as much because of the imbalances between supply and demand. So given that as a backdrop, I would say that the Federal Reserve was acting more in relation to the softness in the labor market than it is to inflation pressures, which, by the way, have actually increased from the last time the Federal Reserve lowered interest rates in September of 2024. If you look at the consumer price index, for example, it peaked, of course, but at a high level. But in August of 2024, you saw that number at 2.6%, and now it's rising at 2.9%. So a small incremental change in inflation, which basically tells me that the driving force behind the latest Fed easing of only 25 basis points was, in fact, the labor market weakness, as you heard before, because of the downward revisions. But again, those downward revisions are occurring for a reason. One, the response rates on those surveys has come down significantly. So when you get more accurate data, of course there's going to be revisions. When more companies respond, which they're responding later, you get these revisions. So it's not so much that the data is completely unreliable. It's that the surveys are not reliable because they're coming in later. So when the Bureau of Labor Statistics makes their first estimate, they're doing so with less data. So obviously those numbers are going to be revised.
So you need corrections there. Daniil, seems like there's a hiring freeze. At the same time, there's a shortage of supply in terms of labor. So that's a problem from both sides.
Right. So as John mentioned, at the same time as the supply is shrinking, the demand is also shrinking. And we have been seeing dramatically lower dynamism in the market. So basically, hiring is down, but also firing is down. So fewer people leaving jobs, fewer people being hired. And as the previous speaker mentioned, the immigration is one of the driving forces probably of both, because first you have lower supply of workers, but also people who are leaving are consuming less. And you would imagine that people losing their right to work, like work authorizations, are going to be in extreme saving mode, so they're not going to be contributing to the economy as much. So it's a race between supply and demand, and the Fed's job is not making sure that GDP keeps growing. The Fed's job is to make sure that the labor market remains balanced, and basically it has to find the middle ground between the shrinking demand and shrinking supply. So, to me, the cut yesterday was basically a risk management cut, because we have seen some weakening in the labor market, true, but in a broad picture, unemployment rate is basically flat with a year ago. And last few months, the trajectory was slightly up, but it's 4.3%, which is still pretty good. So it's the risk side of things is that the labor market could weaken further. That's driving things. And on the other hand, inflation, there's a risk management side to that as well. So in like broad numbers have picked up in recent months, largely driven by goods inflation, possibly or most likely because of tariffs. But some of the more dramatic forecasts of inflation accelerating did not come true. We keep seeing, some pass through of tariffs, but not much. So on the risk side, I think the risk of inflation accelerating more has declined. So basically, inflation risks have declined, but labor risks have risen. So that's the reason to try to get policy to a more neutral stance. And broadly speaking, the policy is still slightly restrictive. So you want to be closer to neutral.
John, a look at the U.S. situation from outside, the supply side, for example, of course, what happened to the Korean workers, for example, and also Chinese students or immigrants from Latin American countries. Obviously, people feel kind of like hesitated, let's say, to move to the U.S., at least for now. That will be the situation probably for a while. You think lower interests that will, in what way that will work to help ease the situation?
Well, I think I totally agree with our previous panelists that it is actually not a strong reason to decrease the interest rate. I think the labor market number is, in my view, is not very decisive. It's not a strong indication. Let alone it might be even premature to conclude there's a trend going on right now. On the other hand, I think the inflation is a present danger here. I mean, even though the numbers showing for this month is not that high, but we all understand that these tariffs are for real, and sooner or later these prices will be reflected on the prices as American consumers are buying things for. It's inevitable, in my view, that inflation is going to kick in. It's already kicking, for some time. If you look at the price level today versus, say, a year ago, it's very high. I mean, right now, it's actually very expensive for American households to make a living for an income source of, say, around like $4,000, $5,000 a month. Everything's going up. So I think I view this more of a succumbing to political pressure from President Trump sort of in a dignified way. I think for some time, Jeremy Powell has been resisting the pressure from President Trump, and now he, grabs a statistic saying, well, this is something that can justify this action, and they find that he's doing it. So I think, President Trump has this policy that interest rate should be low, dollar has to be weak, and Powell, even though may not agree with him entirely, at least timing-wise, I think at this point, this is a good reason to do something, I guess. Okay. I mean, there's a precedent here that if you don't listen to President Trump, there's a real chance that you might be fired.
Right. Right. On that front, the political pressure from the Trump administration, Kathleen, that's real. But with the latest rate cut, do you expect or do you see the pressure will be gone, or there will be reduced pressure on the Fed?
These are very unusual times where a lot of things are happening very, very quickly. Firing a governor from the Federal Reserve Board is a unique event. I don't think it's happened before. And it's now going to the Supreme Court. It's being contested. So it's now involving many factors. It's difficult to know where that goes. He's made it very, very clear he wants to get rid of Jerome Powell, and he's put Stephen Moran as a governor. And all of that changes the complexion and sense of Fed independence. Notably, Moran was the only one voting for a 50-point cut yesterday. And the other two governors that had voted for a larger cut last time voted with the majority. Let's see, that's Waller and Bowman voted with the majority yesterday, which might mean they're sort of circling the wagons and trying to reinforce Fed unanimity and independence.
Well, so, I mean, maybe behind the scenes there will be some politics, let's say. But Anthony, to you here, we mentioned a little bit about the inflation. John says, ultimately the tariffs will kick in. But so far, people asking, where is, this inflationary pressure? Yes, they're wrong, but not as much as people expected. And obviously with this rate cut, even the Fed, do not see that as a big threat, let's say, at least in the near future?
I think that's right. The Fed basically said that its risk management move, which is the way the Federal Reserve categorized it, was justified because of the weakness in the labor market. But I think you bring up a very interesting question as to whether or not inflation has picked up because of the tariff. I recently wrote a Substack article on this topic, and what I found was that if you look at the products that are heavily imported, those prices are rising on a month-over-month basis, and you could even look at them on a year-over-year basis. They're going up substantially faster than underlying consumer prices. So if you look at household furnishings, you look at footwear, they're growing anywhere from 4 to 7 times faster. So that's clearly the impact of the tariffs. Now, you are also correct in saying that there is not a lot of inflation. And the reason for that is you're getting offsets. Energy prices have come down quite significantly. And the parts of the economy that are softening are also facing somewhat deflationary pressures. So they're offsetting and sort of masking the effects of the tariffs. And then let's not lose sight of the fact that many companies have admitted that they bought a lot of inventory ahead of those tariffs, so they were able to sell those products at a cheaper price. And people say, oh, that means the tariffs are not having an impact. Of course, the products that are being sold were not tariffed. But as those prices and products get tariffed, then of course some of that's going to be passed on. But even then, what are you seeing among corporations? You're seeing corporations, in some cases, cutting back their costs, maybe not hiring as many workers. And that is to offset the higher costs of the tariffs and even eating some of those tariffs because of political pressure from Washington. But they cannot do this indefinitely. One of the biggest stores, box stores like Walmart, they have 4% margin. How can they absorb a 30% tariff if they're running on a 4% margin. Very difficult. They can do it over short periods of time, but eventually they will have to raise prices to some extent. And already we've heard a lot of companies, Ford, General Motors, Black & Decker, and many others, telling us that they are lowering their earnings estimates because of tariffs. So obviously they're absorbing some of those tariffs, and consumers are absorbing some. But again, it's being shared, and that's why you don't see it as much in the inflation numbers.
So, Daniil, you agree? I mean, ultimately, we will see the inflationary pressure will go up. All these numbers will go up. Right now it's like 2.7, 2.9% in terms of inflation, the CPI. But that will go up to a level maybe around 3 or even higher. But that's acceptable?
So the Fed typically tries to concern itself with the rate of inflation, and what they care about that the inflation does not sustain. So they say that a one-time price jump, which is what they currently think tariffs will do, should not affect their thinking much because it's a one-time event, and unless it gets embedded in inflation expectations, in behavior of consumers and businesses, it's not really a concern of theirs. So you can make a theoretical case that in response to increase in tariffs, the Fed should be cutting because that hurts the economy, and the Fed should be helping it maybe basically smooth the transition. But that's not what their at least mode of operation has been. So the risk here is that inflation rises as expected, and all of the things that that the previous panelists said are true. You can argue about the extent, but I mean, the peak of inflation due to tariffs is probably still ahead, probably sometime late in 2025. But the question is, does inflation, the rate of change of prices, linger or stay high after they have peaked due to tariffs? And that's the real culprit for the Fed, because they know the risk is there, but it will take at least half a year to see whether inflation has begun to slow down after the kick due to tariffs. So it's the risk side of things. They know that prices are probably still going to keep going up. They're not sure of the extent. Some of the early estimates suggested basically that consumer prices are going to rise mostly one-to-one to account for tariffs. I think that's quite unlikely, and long history of similar shocks, exchange rate movements and stuff like that, show that consumers on the U.S. side typically get maybe a quarter of external cost pressures that producers face. Some of it will get passed on to foreign suppliers. Some would get eaten by businesses. So all in all, inflation is likely to still keep, maybe not edging, but still accelerating through probably the end of this year and next year. The Fed is fully aware of that, and they currently expect that not to last. And we will know if they're right or not sometime early in 2026. By that point, we'll probably have somewhat lower rates already. And if inflation sticks around, they'll probably have to reverse or adjust course.
Oh, right. Anthony, in what way this rate cut will help the economy, or which sectors will benefit the most probably from the rate cut? What does that mean to consumers, for example?
Well, it's very clear, Chindor, that what we see is the interest-sensitive sectors are going to benefit the most. Obviously, the auto industry, which relies on a lot of loans, short-term loans to some extent, will benefit. And the housing industry will benefit to some extent, but not entirely, because home builders basically borrow at the short end of the curve. Home buyers recently have been borrowing at the longer end of the curve. And if you look at the rates that determine what happens to the mortgage rate, it's namely the 10-year U.S. Treasury yield. And since the Federal Reserve cut rates, initially it didn't go up. It sort of went down right within minutes after the Federal Reserve cut rates. But since then, what have you seen? You have seen that the 10-year Treasury rate has been moving higher, and that's tied to the mortgage rate. So mortgage rates have not been going lower. They're actually moving higher. So you don't get that real benefit from that because the market perceives that there is at least a risk for now of potentially higher inflation in the future. So you could just imagine if the Federal Reserve would have cut rates by 50 basis points or even by 300 basis points like the president was lobbying for, I think you would have seen mortgage rates go up by even more with the fear that inflation could pick up. So for the moment, you're seeing that some businesses that borrow at the short end will benefit, consumers buying cars, but not as much for home buyers, which are already facing a serious affordability crisis because mortgage rates have not really come down since the Federal Reserve began last cut rates.
Mm-hmm. But Kathleen, here seems this is like a contradictory phenomenon or pressure maybe for President Trump. Like when it comes to like the midterm election, for example, if yes, a rate cut will juice the economy, support the economy, but at the same time it will likely drive up inflationary pressure. People will not be happy. Consumers will not be happy. That will not help him or Republican Party with the midterm elections, right?
I think the point is the Fed can cut its policy rate, but the bond markets and creditors determine the rates in the real economy. Mm-hmm. And so, as we heard, initially yesterday, the 10-year yield fell a little bit after the rate cut, but by the end of day, it had surged back higher. And we are seeing delinquencies and defaults in various sectors, and including auto finance, the low end of auto finance. There was a recent bankruptcy for high-risk borrowers on car loans. And credit card delinquencies are rising on $1.2 trillion in credit card debt, which is, of course, a record level for the American public. So it's not clear that the Fed has control over transmission. And Jerome Powell yesterday, the statement he made that struck me was, there are no risk-free paths. That whatever they did, they were taking risk. And so he has to be guided by not the risk he's setting, but by what's happening in the bond markets, because that's the judge and jury of whether a central bank is credible.
Yeah. John, let's take a look at the repercussions on the world, probably here in China, for example. What does that mean to the Chinese assets? Are we going to see more like investment in the Chinese RMB denominated assets, for example, A-shares or Shanghai stock?
Well, I think one effect that's pretty sure is that the attractiveness of holding U.S. dollar-denominated assets is getting diminished a little bit. I think, from a capital exodus point of view, there will be less money flowing to the United States, mm-hmm. if not maybe even some money coming back from the United States to the Asian markets. So I think that's probably a good sign. And another thing is, obviously, RMB gets a little bit of appreciation. That's more purchasing power for people traveling abroad for travel, mm-hmm. For buying things. That's the money stretches a little bit longer. And I think also, but there's also an impact, by the way, on China's exports. I think we're seeing Chinese exports to the United States, month after month, actually, it's coming down. Mm-hmm. And I don't think our government is too much concerned about that. This is exactly what President Trump wants, and if that's what he wants, that's what he gets. And this depreciation of the dollar and appreciation of RMB would further add to that trend, I would imagine.
Speak of that, interestingly, the Treasury Secretary Bessent said recently, right after the Madrid talks between China and the U.S., he said, appreciation of RMB, so that's not a problem for China, but somehow the Chinese currency is a problem for the Europeans because Chinese export increased. Is there a point, or, what's he trying to say?
Well, I think it doesn't affect too much the competitiveness of China's exports to the European market because the euro has already appreciated significantly for the last couple of weeks and months, and I think RMB just merely catching up. Getting a little bit stronger doesn't affect the picture too much, I would say, from exporters' perspective, because they're already, getting some a little bit of an incentive right now and just giving back a little incentive, at this moment when RMB appreciates. So I think it's not much of an issue at all. I don't know what it's coming from. I mean, he's trying to blame RMB for not appreciating fast enough. Is that what he's trying to say? I don't know. I mean, I think it doesn't make much sense. I think he would be better off just worrying about the relationship between the United States and China, the bilateral trade, investment relations between the two countries.
Well, Kathleen, you want to weigh in?
A couple of things. I looked at the TIC data, the Treasury foreign holders data, just before we started, and buying of U.S. Treasuries is increasingly concentrating in the Anglosphere. So once again, United Kingdom was a big buyer. Cayman Islands is now in fourth place as a big buyer. And other countries, including Japan, are sellers. They're diminishing their holdings of treasuries. So clearly there's less demand for treasuries in the world, except from the Anglosphere allies of the U.S. So that's one thing. And the other thing is, Europe is in a very difficult place. It's lost its cheap energy supplies from Russia, although it remains Russia's biggest customer for natural gas. But it's at higher prices. It's losing competitiveness in its industrial base. So German big automobile companies, Volkswagen, Mercedes, BMW, are closing plants. And an auto parts company in Germany recently filed for bankruptcy. And that undermines the whole dynamic of Europe, which historically for decades has relied on German prosperity to subsidize the weaker parts of the Union. But they're being competed away in agriculture by Russia and Brazil. They're being competed away in industry by China in just about every sector. And they have huge, huge debts that are trapping them in fiscal dominance now. So yes, Europe has lots and lots of problems. By fiscal dominance, I mean that they have to borrow more in debt to keep paying the interest on the existing debt. Now that's a problem throughout the G7. It's a problem everywhere that has excessive government debt. But Europe increasingly has one challenge mounting on another, and it's becoming cyclical.
Mm-hmm. Daniil, some analysts, argue the Fed's move reflects more than just a short-term caution. It could signal that U.S. long-term growth potential has slowed compared to pre-pandemic levels. Is that, a justifiable concern? 1 minute, please.
So the biggest driver of what happens in the economy is the number of people. And we've seen some significant changes in short-term population growth, and longer-term, the main challenge is population growth. So without significant immigration, there's probably going to be fewer people. But it's going to have to rely on productivity. And it's possible that the current AI boom is going to produce lots of labor productivity increase, and that's going to help. But we are not going to know that for a while. So the challenge is there because population is going to grow slowly. Let's hope AI saves us.
Well, on that note, we come to the end of today's show. Many thanks to our guests. You can also watch us on the CGTN app or on YouTube. Thank you for being with us. I'm Xu Qinduo. See you next time.